welcome. This is the Financial Thought Exchange podcast, where you get a little wiser by learning from the leading thinkers in finance. I'm your host, Laura Moberg, and today our guest is Zack Ellison. He has a CFA and CAIA, and he's the founder, managing general partner, and chief investment officer of Applied Real Intelligence. He also has his own podcast called The 7 in 7 Show with Zack Ellison, which I'm enjoying listening to very much, and I, of course, recommend for everyone to listen to. So welcome, Zack.
Oh, thanks for having me.
So this conversation is part of a series of conversations we have around our piece that is coming out with the Research Foundation, hopefully published by the time that we launch this video on alternative credit. It's called An Introduction to Alternative Credit, and Zack has contributed a chapter for that piece on venture debt. And this is a collaboration, the whole piece is with the CFA Society of New York. And in this piece, Zack educates us on venture capital, really great, good overview, what the field is about, what the outlook is, which is what we want to cover today. So maybe you can start, Zack, by just introducing to us, what are we talking about? What is venture capital? What does it entail? And it might sound like this is all about the small companies, startups seeking their first round of funding, or does it come later? So we can get an overview.
Sure. Yeah. So let me start with what venture debt is. It's very misunderstood. It's a term that I think most institutional investors or investors of any type really don't understand. And over the last couple of years, it's been gaining a lot of popularity, and there remains a lot of misconception. So I'm going to explain exactly what it is. So when you say venture debt, another title for that is growth capital. So people hear the word venture debt and their mind typically thinks risk because they associate the word venture with risky, because they're thinking about traditional venture equity investments. Venture debt is very different. The venture within venture debt basically is saying that these loans are made to venture-backed companies that are successful. So I'm going to walk you through what a kind of standard venture debt loan or venture debt product looks like. So essentially, as startups grow, they finance themselves with equity, and eventually they start producing revenue, and the good ones eventually become profitable. So once companies have revenue to the point where they actually have the money to service debt and pay interest and pay back the loan, a lot of companies at that stage start to look at debt as a complement to their equity financing. So think of it like this. Company starts, it's two people in a garage with their laptops and their dog, and they're coming up with an idea, and they're not going to make money for many years typically. So they go out and they raise a friends and family round with people that know them well, and they raise a couple $100,000. Then if it goes well, they're going to raise some more money, and that might be through what's called like a seed round, or nowadays there's typically a pre-seed round and then the seed round. And then they would eventually get to the point where they're looking for institutional capital from venture capital firms, and that's when they typically would do their Series A round. And at that point, some of these companies are still pre-revenue, but some of them also start to get to the point where they're generating real revenue. And so typically venture debt comes into play once a company has sufficient revenue, which every lender is different, but typically 10 million is kind of the starting point for when venture debt makes sense. So once a company reaches that stage where they've got 10 million in revenue, which is usually going to occur after their Series A round, sometimes after their Series B, they then will start looking at debt as a complement. So at that stage, they'll go out to lenders, and we'll talk about who those are later. And the product will typically be a 3 to 4 year loan. And this is a loan that will be interest-only payments for the first, call it 12 to 18 months. And then the loan will start amortizing, meaning the principal will be paid down over time. And most of the time, that's straight line amortization, meaning the principal is paid down in even installments over the remainder of the term after the interest-only period. So think about a basic loan as 3-year loan. It's typically senior secured. It's almost always the only debt in the capital structure for most of these companies. So the lender will have a first lien on all the assets of the company in most cases. And The interest rate, we'll talk about that, but it's mid-teens type interest rate. And there's also equity warrants attached to the deals, meaning the lender has the right to buy shares in the company at a later date and participate in their equity upside. Most of these loans go to companies that are VC backed, which means they're typically going to tech companies because VCs are typically backing technology companies that have a lot of scalability and a lot of growth potential. So think of the uses of venture debt from a founder's perspective as growth capital, a little incremental capital to add people to their team, to develop the product, to expand their marketing offerings, to maybe enter into a new market. That's probably use number one. It's just growth and expansion. Another use that's very common, especially now in this market, is helping to bridge that company to a higher equity valuation. So for instance, the company may know that if they achieve a certain number of milestones or the macro economy is going to get better over the next, call it 2 to 3 years, they might not want to raise capital today because they know their equity valuation is going to be significantly higher in a couple of years. So they'd rather borrow money now, use that to support their growth. And then when their equity valuation is much higher, then they'll go and raise equity. So think about that as the second most common usage. Then there's also some firms that use venture debt for working capital or operating capital. And those are really the three main uses of venture debt.
Yeah, it's really useful to remember that it's not about capital at that very first. It's not like angel capital. Usually there's no such thing because in a way, and one aspect of that, right, would be it kind of doesn't make sense to borrow to a company that is only an idea so far because they default and that's your money gone.
Yeah, think of it as venture debt comes after the equity raise and after the company has been successful. And I'll give you an example that makes it very clear for people that aren't really familiar with this product or investing in general. Think about going to a horse race and you're going to bet on horses. Equity investors, especially early stage equity investors, whether they're angel investors, seed investors, Series A investors, they're basically betting on horses that have never run. They've literally never been on the track. They're looking at them saying, that horse looks kind of like it's got a good set of legs on it, and the jockey seems like a decent person that won't fall off the horse. We'll place a bunch of bets on a bunch of these horses we've never seen run, right? Mm-hmm. And almost most of them will be losers, but some of them will be winners, right? That's the equity analogy. Lenders are very different. We let the race get started. The race is being run. It's being funded by these equity investors. When the race is probably 80% run, now we get to place our bets. And so we're not always going to know who's going to win, but the race is already 80% run. So we have a very high probability of being able to pick the horses that are going to win, place, and show. And on a probability adjusted basis, it's much better to be a lender because the hits are very, very high. You're probably going to be right, 95% of the time versus 10 to 20% of the time as an early stage equity investor.
Well, you mentioned that the rates are in the teens or low teens, I think you mentioned. Is there like a reasonably fixed spread there so that if, say, the prime rate or the sulfur or whatever you want to think of as some kind of benchmark rate increases by, say, 3%, been seeing some really big jumps. Have you seen the equivalent jumps in the interest rates going to in the venture capital space?
Yeah, so loans in the venture debt world are almost always floating rate. I would say roughly 95% of the time they're floating rate loans. And depending on the lender, they can use either a benchmark rate of prime or SOFR. It doesn't really matter, right? The reality is that, let's say you're using prime as a benchmark. Prime is at 8.5% today. It was at 3.25% before the FOMC started hiking rates in 2022. So you've seen a 525 basis point increase in the base rate. And then you have a spread on top of that. Now that spread's going to vary like it does in any credit product based on the risk in the market and the lender's assessment of whichever particular company they're lending to. But we have actually pretty good data because there's 5 publicly traded business development companies that have to disclose their portfolios and the details on their portfolio loans. And one of those details is the pricing, which includes the base rate and the spread on every loan they've made. So I've looked back and studied that data over 20 years. And so I know exactly where the market's been every year in the last 20 years. And right now that spread has gone up. But I think in general, you could say that spread is going to be about 400 to 600 basis points over the prime rate. Right now, it's at the higher end of that range. It's actually probably closer to 800 basis points on some of the loans that we're looking at. So historically, the cash yield earned on these loans is about 15%. And of course, that varies. It depends on the stage of company that the lender is targeting, and how much equity exposure they're taking relative to the credit exposure, and a whole bunch of other factors. But we know for certain that you're going to get a mid-teens return for the most part, and that's from the credit. And then on the equity side, because you've got equity warrants in the majority of these deals, that historically is a little bit harder to measure because these are private deals. And a lot of times equity warrants aren't monetized until much later, sometimes after the loan is actually matured. So it's hard to get exact numbers on the equity returns, but I know most of the folks in the space and have looked at thousands of loans, and it's typically call it 3 to 5% return is what you should expect to get from the equity exposure. So all in, you're talking about a 15% yield from the debt and another 3 to 5% from the equity historically. So high teens. And in this market where capital is very hard to obtain, there's a shortage of capital, that's all increased. So you're basically getting sometimes low to mid 20% return with the same risk profile as you would have gotten previously. Actually, lower risk profile because you can have much more stringent terms as a lender in this market.
Oh yeah, the covenant's another aspect of this. I would actually have thought that the spreads would have been somewhat smaller in a high rate environment, just because there's some point where companies cannot no longer really service a high rate loan.
Yeah, there's a cap. So I should give you a little nuance. In the bank loan market, so if you're a startup founder, you're running a startup, and you go to a bank lender, capital is going to be cheaper. You're going to basically pay prime plus, call it 50 to 150 basis points, right? So around 10% cash in this market is where the bank market is. The non-bank market, so all the BDCs that I mentioned, other private lenders, they're going to charge a higher rate because they don't get all the ancillary business that the banks get. And so there's structurally two very different markets. The bank loan market, where banks are making a lot of their money off non-lending, where they're getting cash, they're getting deposits, they're basically doing all these services for the startups that make them risk-free dollars. Whereas the non-bank market doesn't do any of that. So they're taking more risk because they don't get that non-risk business. And so therefore they're going to charge a higher rate. And there's other things that could go into that too, which we might as well get into. And typically what you're going to see in the bank market is they're going to provide revolving credit facilities, or they're going to provide small term loans. And they're also going to require a big chunk of your deposits. And they're going to want basically all your business. They're going to want all your banking business. That's why you get cheaper capital from them. They're not gifting you this. It's kind of like a hook. It's like the chum in the water. Like, let me give you a cheap loan, and now I'm going to take all your business, right? Now, the non-bank lenders it's going to be more expensive. They're not going to provide revolving credit facilities because those aren't economical on a standalone basis. So they're providing term loans that are usually bigger than the bank loans and longer duration. They're also a lot more flexible. A lot of the non-bank lenders excel because they're more flexible in their structuring. They're probably better, quite frankly, in many respects. Certainly they have more leeway to do things that a lot of the banks don't because they're not regulated in the same way. And they're also a lot faster, which matters immensely because as a startup, everything is measured almost in dog years. Like if you talk to any founder, like 6 months for a founder is like 5 years for a Fortune 500 company. And so if you can get someone capital quickly as a lender, it doesn't even matter if you're the cheapest capital, because getting it to them fast in a structure that fits their needs is what's really most valuable to them.
Right. So just to understand a bit where the money flow is going in this space, then, first of all, how big is venture debt? How much money is in it right now?
Yeah, so it's grown a lot. So to put it in perspective, 10 to 12 years ago, it was only about a $5 billion market each year. $5 billion in loans deployed in the US, not globally, we're just talking US. That grew a lot. It actually grew so that it reached the point where in 2019 through 2022, in each of those years, the amount of venture debt deployed in the US each year was between 30 and 35 billion. So think of it as like a roughly 6x increase from the GFC time frame until 2020-ish. And it was at that 30 to 35 range for 4 years. And then last year, 2023, it collapsed, and it was roughly call it 12 to 15 billion last year, depending on whose estimates you're looking at. And there's a number of reasons for that. And if you want to get into those, I'd be happy to.
Sure. Give us a sense.
Well, I think the big thing is that the venture equity market collapsed because there were so many companies being funded at high valuations in late 2020, all through 21, and in the first half of 22. And when it became pretty apparent that most of those companies were worth a fraction of their last valuation, that really scared a lot of the VC folks. I mean, most VCs that were investing during that period have portfolio companies whose valuations are down anywhere from 50 to 90% if they're still in business. And so basically VCs have pulled back a lot in terms of capital deployment. And it's a lot more expensive now to get capital as a founder. It's taking a lot longer to get a deal through the hoop. And the checks that you get written are a lot smaller. So basically think of the equity market as being frozen. And the IPO market, which a lot of folks watching this will know well, the IPO volume is down over 90% from 2021 to 2023. So there's nothing going on in the IPO market. So none of the larger startups that you thought they were unicorns can exit. So there's a bunch of dead unicorns riddled all over the country and all over the world right now, and they're not coming back. And so that really decreases volume on all fronts, because as a venture lender, you're coming in after the equity raise. You're coming in after the company's demonstrated success. So if you've got a bunch of companies that can't raise equity and are failing, as a lender, you're going to pull back as well. So that's probably the primary reason. And then, somewhat relatedly, there's a number of lenders that were large in the market that provided a big share of the loans. Silicon Valley Bank being the most obvious, but also Signature Bank to some extent. And they failed for other reasons, totally unrelated to their venture debt exposure, of course. And that basically, caused a lot of capital that would have been flowing to come offline. And some of that's come back online after SVB was bought by First Citizens. They're still in business, they're still making loans, but they're a fraction of their former size. And their business model that worked so well is broken, and they've lost the trust of founders, because a lot of companies were put through massive hardship when they collapsed because of their inability to manage risk at the parent level. And so that trust is gone. And just to finish this point, the model doesn't work anymore because the model relied on cash collateralization through deposits. In other words, if I was a banker, I'd say, I will make you a loan to the startup for, let's say, $3 million. But you've got to keep $3 million in cash in deposits in my bank at all times, which I have control over if you trip a covenant. So they weren't really giving them this money for true growth. They were basically giving it to them because it was so cheap. Why wouldn't you take it, right? If you're borrowing at 3%, which is where the rates were, call it 2 or 3 years ago, you'll take that money. But now that model's been broken, because what we learned is if you're a startup or any company and you've got all your money in one bank and that bank collapses because they don't know how to manage risk, now you're screwed. Now all of a sudden you can't pay your bills, you can't access your cash, right? And like I said, time moves quickly for startups. So if your bank is offline and your cash is locked up for any amount of time because of somebody else's screw up, it puts your business under immense pressure and could put you out of business. So there's massive operational risk and business continuity risk with having all of your deposits at your lender. So nobody's doing that anymore if they know what they're doing. Like nobody, right? Like that's an old model that ruined a lot of companies when SVB collapsed. And so now they need to spread their deposits around, which means the bank is not going to make that same loan to them because they don't get all the deposits to de-risk it. So that model's dead. And that's why ultimately this product is not really a bank product. Like banks offer it, they're not suited to do that, right? Like, and that's why many banks have tried and all of them have failed over time because it's just not a bank product.
Just to step back, clarify what you mean here. When you say this model, I think you're referring to the Silicon Valley Bank model that you give an overview here, or having the deposits with your lender.
Yeah, I mean, SVB was the most obvious using that model, but really all the commercial banks use that model.
Yeah.
And so like they can't do that anymore, which means which means they have to charge more for the loan because they have to adjust for the risk. Right. And so they're not nearly as interesting when capital's costing 10% versus 3%. Right. Like at 3%, who wouldn't borrow? At 3%, it's almost free. At 10% plus warrants, now you have to make a real decision. Do I want to actually work with this institution and be locked in so many ways, even if I'm only saving a couple hundred basis points on this loan? And the answer many founders are making is no, I don't. I'd rather work with a non-bank lender that doesn't constrict me in all these ways.
Just to recap here for people, we're talking about Silicon Valley Bank. This was a bank that was very big in the space of lending to, and as Zack was talking about, taking deposits from also a lot of tech companies. Silicon Valley Bank, so-called because it was founded in Silicon Valley. A lot of Silicon Valley companies were doing business with them. So it'd be great to understand the role of this crash that, for the people who are paying attention to it, seems like a pretty big deal. When we talk about the flows in the space, the collapse of this bank, and by the way, we're not going to talk about all the ways that it collapsed. They had a lot of intricacies in the risk management, let's say risk management, you can say. But did the collapse of Silicon Valley Bank decrease the flow in the space, or was it really quickly filled up by other players?
Yeah, like I said before, I mean, volume went from 30 to 35 billion in the 4-year period prior.
And that was a Silicon Valley Bank effect, so to speak. It wasn't like macroeconomic effect. It was Silicon Valley Bank.
Well, like I said a few minutes ago, it was because the venture equity ecosystem is struggling right now. And so there's less capital being deployed by VCs, which means there's also less capital being deployed by lenders. So that's a big part of it. And then related to that, exacerbating the problem is that the biggest lender in the space that was about 50% market share blew themselves up. And so now they've been purchased by First Citizens in North Carolina, and they're trying to revive the business, but it's a shell of its former self. And so you basically have had macro events, and you've also had supply constraints because Signature Bank also supplied venture loans, and they failed as well. And so there's a lot of supply coming offline, not just because of those two banks basically failing, but also because other regional banks are pulling back as well from many credit products because they've gotten over their skis in terms of commercial real estate exposure, and they've also mismanaged their books in the same way that SVB did, right? Where they basically have the risk of deposit flight, and they have balance sheets that are going to get decimated when they finally mark their commercial real estate exposure to market values. And so everybody who's in the market knows this is coming, and the banks know it, which is why they're pulling back on their lending significantly. And they're especially pulling back on things that they deem to be non-core or, quote, risky, because that's what the regulators are requiring them to do, and that's what they're going to need to do to survive. And if you think about venture debt, this is a product that is, unless you structure it properly, it is inherently going to be a little bit riskier than a large loan to a mature company that's got ample asset coverage from hard assets, right? And so bottom line is there's actually a massive gap in supply and demand right now. There's huge demand from founders because they can't get funded on the equity side. They can't exit because the IPO market's shut. So they're literally sitting there going, holy cow, I'm going to go out of business if I can't organically generate cash flow because I can't raise money the way I was raising money previously. So what are my options? I either figure out how to get to profitability on my own, or I need to go borrow some money because there's literally no other option. That's it. There's 3 options to raise money: equity, debt, and organically, right? And so if you can't raise it on the equity side, and organically you're struggling too, because you're counting on more capital to juice your growth, and now you're realizing, oh wow, I actually have to run a profitable business. This is actually harder than I thought, right? Well, all those folks are looking for alternatives, and so they're all looking at the debt market. But on the supply side, like I just said 3 times, SCB out of commission, Signature Bank out of commission, other regional banks pulling back, right? And then you've got the other non-bank lenders, and they're struggling too because they were making loans at the peak of the market, chasing hot deals, pricing the loans wrong, like the spreads were too tight, base rate was too low, they didn't have good covenants in place, sometimes covenant-light deals. I mean, just silly risk decisions in hindsight. But they did it because that's what the market dictated at the time, right? So everybody's now paying for their past sins. And you know who's getting screwed? The founders. Because these are people that are like, hey, I'm just trying to build a business. I thought I was going to have access to capital in some form, and now it's all taken away from me with no warning or very little warning. And now I've got to figure out, how do I survive without all this capital that I thought I was going to have access to? And that's why venture debt, or specifically lenders in the market now who have a clean balance sheet, are going to absolutely perform better than anyone could imagine, because they've got a clean balance sheet and they've got capital that everyone wants, which means they can be highly selective, which means they can have really, really tight deal structures. And it also means they can price these loans to the point where it's still fair, but it's at the very high end of the pricing range.
It's clear what you're saying. This is a very tight market. So what makes this turn around? What are you looking for to understand that this environment is going to start loosening up in any way?
When you say this environment, you mean that when is it?
The environment of being, yes, the dearth of capital. Nobody wants to lend. It's really hard to raise any capital, not only debt, but also equity capital.
I was a trader for a long time. And so this is why I do best. And it's hard to say exactly when the market will thaw, because the other thing we haven't seen happen is a real recession hit, which a lot of smart prognosticators think is in the works. And I'm on the side of those folks that is actually a lot more bearish. We've got the S&P at all-time highs. And we've got this like perception, I think, by a lot of the market that things are going to keep getting better, that all problems are going to be solved by AI or some crypto bullshit. And it's not, right? Like the reality is you need real product, and most people are focusing their capital allocation now on things that aren't even real, right? Crypto, not real, total waste of your money. Yeah, AI, yeah, it's going to change the world, but most investments you're going to make in AI right now are going to lose you money, because everybody's coming out saying they've got some AI edge, and most of it's hocus pocus bullshit, right? And that's that's the frankest way I can put it. It's utter garbage, right? And so that's where the money's going, right? And that's what the VCs are investing in now, which is kind of funny to me, right? Because they just got blown up from their stupid investments in 21, and now they're doing the same thing again with the AI bubble. And so, so I think when a real recession hits, which it will, I don't know when that'll hit, but it will hit. Inflation's not tamed yet, right? And so you've got a risk of stagflation, which is even worse than just a recession. And when that happens, you think the IPO market's going to get better? You think that like M&A is going to pick up, right? I mean, no, it won't. I mean, just to answer a rhetorical question, like when the economy goes down and S&P goes from 5,000 right now roughly to 4,000 or 3,500, that's going to flow through the rest of the risk markets as well. So I think it's going to get uglier actually before it gets better. And so if you ask me, like, when's it going to get better? I'd say after it gets worse. We need to have a flush. We need to have a great reset, get all these fakers out of the market, clean up all the bad decisions that people have been making over the last 3 to 5 years, and start thinking like real investors again. Look for companies that actually can produce real product, real profitability. Just enough of the like games. Let's focus on funding good businesses.
it's a little bit depressing words for the entrepreneurs in the room. But does that mean that it's a good environment to be a lender now? Like, is this an excellent time to be on the other side of the table, the person offering the venture credit?
Yeah, I mean,
and the venture debt?
yeah. So it couldn't be a better time. Just to be clear, I think this is the best time in history to be a venture debt provider or a growth credit provider, because, like I said, everybody needs this capital right now. All the startups, they can't get alternative capital. And so what that means is there's a supply and demand imbalance. So this is economics 101. If there's more demand for a product than there is supply, the price is going to go up, right? So which means as a lender, not only can you charge higher rates and take more of an equity stake, a larger equity stake, but you can also be incredibly selective, because for every deal that's getting funded, you've got 20 opportunities, maybe 30. And so you could say, okay, out of these 30 opportunities that came across my plate this week, which one's the best? That's the one I'm going to look at. And then if I do that deal, I'm going to get all my terms that I want, because they don't have an alternative, right? And so it couldn't be a better time. Like, it's hard to even express how exciting it is to be a venture lender right now, provided you don't have a legacy loan book of garbage that you underwrote during the peak of the market, right? And that's a big contingency, right? That's a big, if you don't have that, you're in great shape. If you do have that, you're going to have to work through that. It's going to be pretty nasty.
You mentioned AI and things like that, and of course that's where people want to put their money now. But you wrote also in your piece for us that the venture debt is provided predominantly to tech-enabled companies. I'm always a bit confused about what tech-enabled in this world means. Like, anyone who employing email in their daily exchanges, probably not. But maybe you can expand on that a little bit if we just want to understand kind of where the money has been going and is going, and why it is that the tech-enabled companies, as opposed to anything else, is getting the debt capital.
So remember, venture debt is provided to companies that are already venture capital backed. Okay. So what you have to look at is the top of the funnel. Like, where does the pipeline begin? What do VCs invest in other words? Because if the VCs don't invest in it, the venture lenders aren't going to be able to invest in it, because it won't exist, right? And so the reason the majority of these loans are to tech companies or to companies that are utilizing technology to create efficiencies is because that's who the VCs back. VCs aren't making investments because they want to get a 10% annual return. Their strategy is make a lot of investments. Most of those will fail, but they're really counting on the big winners, right? So they're looking for companies that are return anywhere from 10x to 1,000x, right? And that's the goal, because if they get a couple big hits like that, the rest of the portfolio can be zeros or ones and twos, and it won't matter. And so that's ultimately why venture lenders are also backing these tech companies, because what happens is the VCs make all the equity investments. Those that succeed and continue on in their path, and they make it from friends and family to angel to pre-seed to seed to Series A to Series B to Series C, that's when the venture lenders come in, right? And so venture lenders are basically saying, we're just going to put more money behind the winners. We'll never even look at the losers, because they literally won't exist anymore. They'll go out of business before they're even in the vision line of the lenders. And so I think that's probably the easiest way to explain it, is that we as venture lenders invest in the best VC-backed companies that have proven they have traction, that have proven success, right? That we think still have a lot of upside. And we're going to give them capital because we believe in that upside, and we're not making a 10-year bet, right? Like, the one thing that's really important here is timelines. Equity investors, especially those that start early, are thinking 10 and 15-year timelines, right? That's how long it's going to take a company at the angel stage to typically be worth something of note, 10 or 15 years. Lenders aren't doing that. We're making 3-year loans to companies that have significant demonstrated success. And we're saying, well, I can't look ahead 10 years. Like, I don't know what the world's going to look like in 10 years. We might all be living in Mars or in pods on Earth. Who the heck knows, right? But I'm very good at, and other lenders are as well, looking ahead 18 to 24 months, sometimes 3 years. It's much easier to look ahead 1 to 2 to 3 years than it is to guess what the world's going to look like, when our kids are fully grown, right?
Right.
Very different risk.
When we think about the sectors, is the technology sector dominant here in terms of receiving venture debt?
Yeah, I mean, the majority of venture loans are going to software companies,
Mm-hmm.
and they're also going to life sciences and biotech. Those are the two largest sectors by far. And so, those are sectors that have a lot of upside. Like if you think about a software company, it could be small today and it could be tomorrow's Zoom, for instance. Nobody knew what Zoom was 5 years ago. Now it's a huge company. That's kind of what people are betting on in the software space. They're saying, okay, are these businesses really scalable? Right? Do they have high margins? Do they have sticky revenue that's recurring? And can we scale them on a global basis typically, right? Is what they were looking for. Can we get thousands of customers or hundreds of large enterprise customers to use this product, right? And each marginal customer that comes on doesn't really cost the company that much, right? They're just leveraging existing software, right? So their margins are massive, 80, 90% margins in some cases, right? Now on the biotech side, which I do not specialize in, so I don't claim to be an expert there by any means. The reality is these are kind of like zeros and ones. It's binary outcomes oftentimes. If a company makes it through all the trials and it gets to market, it could be $1 billion company or multi-billion-dollar company, but it could also be a zero. And so that's where the VCs are kind of looking, because again, they're looking for the big winners. So they're always going to go to where the big winners are. So they're looking in this market, they're really looking at AI because that's clearly like the biggest opportunity set on the board. But they're also, of course, looking at other traditional SaaS products, software as a service. They're looking at biotech and life sciences. But then there's other sectors, of course, that are in there. It could be entertainment, media, it could be healthcare, supply chain. There's a lot of climate change solutions, energy that are relevant. So I'm not saying that it's only those 2 or 3 big sectors, but if you had to see where most of the money is going, it's AI now, SaaS, biotech, and healthcare. Those are probably the biggest 4 segments.
Well, you mentioned too, like before you mentioned warrants. So if you think that there's an upside and there's always this, you get a little bit of the other equity exposure often as a lender as well. It's easy when we talk about the debt part to kind of compare the loans because we can say, what's the interest rate? In the warrant space, I'm thinking it's a little bit more complicated. There's a warrant piece out there, but there's nothing really standardized out there, right? And maybe there is a 5% is the standard, but I'm thinking the contract there can look very, very different.
Yeah. So what makes venture debt really unique, and one of the reasons I just find it to be a phenomenal product, is almost every loan has warrants attached. So every lender is not only getting that credit component, which is the 15-16% type yield, but they're also going to participate in the upside of the company. And this is an elegant structure because what they're doing is they're aligning interests with the company over the longer term. So if you think about it, say the company's got a 10-year plan to exit. Well, if you're the lender and you're only making them a 3-year loan and you don't have any equity upside, incentives aren't aligned because you don't care how that company does in years 4 through 10. You just want to get your money back and the company could blow itself up and you wouldn't care. But if you've got 10-year warrants, now you're incentivized and aligned with that company. And you want to see them be successful over the long term because you want those warrants to be worth a lot over that 10-year horizon. And for what it's worth, every deal is very different that you noted. And so it's hard to speak in generalities. But that said, there are some pretty well-known market standards at this point. And so on the warrant side, the majority of warrants are going to be 10-year expiries. The strike price of the warrant, right, what you pay to exercise that option to buy shares, will depend on the deal. But in this market where borrowers really need capital, lenders are typically utilizing what's called penny strikes. I mean, they pay a penny to exercise each warrant. And so that's fairly standard. And when things are more borrower friendly, they would price the shares usually at the last round, right? Whatever their last equity raise was, they'd say, okay, this is where we're going to price the shares. That's how we're going to determine how many warrants you get. The other thing that's really critical to know is when you make the loan, typically you're getting what's called warrant coverage, meaning typically you're going to get like 5 to 15% of the value of the debt in the form of warrants. So if I make a $10 million loan with 10% warrant coverage, I get $1 million worth of warrants, right? $1 million being 10% of 10 million. And then I'm basically thinking, well, this is great because if this company does really well over that 10-year horizon, I'm going to get to participate in that. And if it doesn't do so well for whatever reason, well, I'm still going to hopefully get my 15, 16% cash interest and get out whole because I'm the senior secured lender, at the top of the capital structure.
Yeah. So, and I think maybe we should clarify just people may know, or people just have to need a reminder. The warrant we're talking about is not the warrant that you can optionally buy when you buy your vacuum cleaner. This is, as Zach was alluding to, it's kind of an option, right? It says, well, in 10 years or something like that, a certain time frame, you can buy stocks for this amount of dollar for this valuation. And what's great about that is you're not sitting on the information now, but you will sit in the past. And usually information costs something, but this is information for free. You're going to get it for this price, and you can buy it or you cannot buy it.
Yeah, the warrant is really a call option. And so folks that are familiar with call options, and a lot of people are these days, it's really just a call option.
Yeah.
And so good way of saying it too. Now, what's nice too is in a market like this where equity valuations are very low, when you get that equity participation, you've got a lot more upside because you're basically literally buying at the lows, right? You're coming in and you're getting exposure at a price that's maybe 20% of what the company was worth 2 years ago. And so there's a lot of upside there. So I expect the warrants and the equity participation to be worth a lot more in the 2023, 24, 25, 26 vintages, right? Like anybody who's making loans now is getting in at a great time because not only are they able to set the credit terms they want, but they're getting this equity upside at a much lower valuation with very low strike prices. And they're getting bigger chunks too. So when things were hot and the market was very borrower friendly in 2021, the warrant packages were measly, right? The valuations were sky high. Warrant coverage was call it 3 to 5%. Well, now valuations are low and warrant coverage packages are 3 to 5 times bigger. I've seen deals recently that I've looked at personally that are 25% warrant coverage. I mean, that's kind of the extreme, right? But there's a lot I've looked at that are 15 or 20% right now, which you would have never seen 2 years ago.
And again, this coverage that you're talking about is what share of the money that you're devoting to lending, you could also then top that with another 10% or whatever the number is. A bigger number, the bigger is kind of the option in that way.
Yeah, so the warrant coverage is the percentage of the debt that you're going to get in equity exposure. So if you've, again, $10 million loan with a 15% warrant coverage, means you're going to get $1.5 million worth of warrants, right? So on a 3-year loan, you're basically, if you chop that into 3 parts, you're getting $500,000 a year in upside from the equity participation. But if the company does really well and their valuation goes up immensely, those warrants might be worth a lot more than $1.5 million. They might be worth 10x that. And actually, this is a good time to talk about, just briefly, we can dig into it more if you'd like, is the portfolio construction benefits of having this equity upside. So if you think about a traditional credit portfolio, what your upside is. It's capped, right? It's like typically what your interest rate is going to be. Mm-hmm. And then, but you could lose a lot of money too, right? With venture debt, you actually don't know what your equity upside is going to be. And so your returns could actually be much higher, and you're going to have certain credits in your portfolio that don't do well, right? No matter how smart you are, you're going to have some credits that don't do well, maybe some that have losses. But because on the other side of the probability distribution, you're also going to have credits that do better than you expect, and you're going to benefit from owning that equity. Those gains historically have offset losses by 3 to 5x in the portfolios that I've analyzed, right? So think about like, 10, say you've got 100 loans out, and 10 lose money, which is very, very high, right? Percentage-wise versus other types of credit products. But then 10 wind up being huge winners. Well, those winners are going to be worth more and more than offset the losses. And that's why, from a portfolio perspective, this is such a unique product and very powerful in terms of mitigating losses, because you're not capped at the interest rate. You've got all that upside.
Yeah, to your point, it's like you have sold a put, the equivalent of, as you're lending, but on the other hand, you are buying a call. So you get both, just a little bit of both, but you get paid if nothing happens. So that's great. Question more about also, I was wondering about we talked about how money goes into the certain sectors. What other characteristics, when we think about the founders, most people who raise money in this space, we talked about Silicon Valley Bank. Are they all sitting there in Silicon Valley, or how would we think about the features of the people who seem to be capturing a lot of the venture debt here?
Wait, so are you asking me about the founders or the lenders?
Yeah, the founders. And I'm thinking about, so I shouldn't be too obscure, but I'm thinking about things like, if we're thinking about the people, like, is it an ethnicity thing? Is it, what's the distribution look between men and women? Maybe there are other features of people that might be interesting to see the macro picture of.
So you're asking about, is there diversity in venture debt and venture equity?
Right. Yeah, you can say that.
Just to be clear. All right. So, there's not. I mean, 98% of the money in venture equity goes to folks who are not women or minorities, right? So you've basically got 75% of the U.S. population. If you include women, Blacks, Hispanics, veterans, that's a huge percentage of the population, and they're getting just a tiny slice of venture equity and by extension venture debt, because the pipeline, remember, it is set by the venture equity folks. And so it all begins at the earlier stages. So there definitely is a need to create more access for capital, because there's great founders that just don't have the access because they're not in the tight little circles where a lot of these VC-backed deals are springing up from. So that's a big problem, and it's going to take years to solve. I haven't seen anybody who's really been able to solve it. It's something that we're working on the venture debt side at A.R.I. When I say working on it, I mean figuring out how can we create access for the best founders, irrespective of their race, ethnicity, gender, irrespective of what region they're in, irrespective of what sector they're in, because I think there's some big gaps within the venture debt market. So if you think about venture debt right now, there's a gap there. There's a funding gap. But within that, there's other gaps. So it's the gaps within the gap. And so the big three are, which you've already identified, on the founder side, there's a lack of diversity, and it's very hard for folks that are what I'd call typically white males that live in New York or Silicon Valley to get funding. Then there's also a big gap in that, and we talked about this earlier, most of the money flows to the hot sectors, and it doesn't really get that far in some of the other sectors, which are very lendable in a sense, right? They're good sectors, and there's great products and companies being developed in sectors, but they just don't have that that star appeal that AI has right now, or that certain software businesses have, and so they're neglected. They're underserved.
What could be an example of those sectors that people are overseeing?
I mean, there's basically everything but the big four that I named earlier, but it could be anything that's not like really, really shiny and sexy and in the headlines every day. So it could be thinking about, okay, how can you apply technology to supply chain to real estate to agriculture, right? To real brick and mortar businesses that actually have real product, but they need to get more efficient. Energy being another one. I mean, obviously there's a big focus on clean energy and climate tech, but there's a heck of a lot more applications outside of that, right? There's also some really interesting businesses. Like if you go back and look at what venture debt was like 20 years ago, well before I was in the space, but from the many folks I've talked to that were in the space then, they would back all kinds of interesting, unique businesses. It could be, a couple of businesses we're looking at now. We're looking at, there's some really interesting sports and entertainment plays, right? Because if you look at the value of sports franchises and the value of live content, like that's the only thing advertisers are going to pay for, right? Mm. So there's huge options there, because a lot of VCs, have gotten scared of, consumer products for various reasons, because because there's risks there that are a little bit it's a different risk profile than a SaaS company that's got 80% margins and contracted revenue, and everybody's kind of chasing the same set of deals because they're fairly obvious in that they're not going to lose money, but everybody can't do the same set of deals, right? And so there's all these other folks that are like, hey, I have a good business too that will probably make more money than the SaaS business, but you guys just don't understand it, or you're not focused on it, because a lot of these funds are very VC funds are very sector focused. Like they do like one thing, right? Like we do like Series A SaaS companies. Okay, like that doesn't help anybody else except Series A SaaS companies, which means you could have a huge opportunity sitting right next to that Series A SaaS company, and they're not even going to look at that pitch deck, right? And so that's where there's opportunities. You've got to look where others don't, right? So regions that are underserved. So look outside of San Francisco, look outside of the Bay Area in general, look outside of New York, Boston, and LA. Those are the big four. I've lived in all those cities except San Francisco, right? That's where all the deals are getting done. But there's great founders in other places too. Like I'm getting my doctorate at University of Florida right now. There's great companies in the Southeast, and nobody's calling on them, right? So you've got regions that are underserved, you've got sectors that are underserved, and you've got founder groups that are underserved, and there's literally nobody serving them. Nobody. I mean, there's nobody doing it, and that's why there's this massive gap in the market.
Yeah, I mean, it certainly seems that if you were thinking about any technology firm, as you say, you can jump in, you don't have to have much capital. That also means that you have low barrier of entry. And if I were a lender, I would rather lend to not low barrier of entry. I mean, if you have a low end retail shop in a small town selling kind of dollar store type of things, that might be a great shop to lend to, because you know that the people live there and the people shop and the people don't want to go out of town or buy very fancy things, all that kind of thing. So it's a little bit counterintuitive, right? As a person who's not in the space to hear this.
Yeah, well, I'll give you an example of a company that's very kind of traditional, but is also backable by VCs and venture lenders. So think about like a business like HVAC companies, right, that are doing air conditioning and plumbing and roofing and electric, right? Most of these are run by families or sole proprietors, and it's a very fragmented industry, and they don't use technology, certainly not efficiently. So imagine if a company came in and started rolling up HVAC companies, and basically for each company said, we're going to utilize data and technology to help your company. Marketing is going to be much better because we're going to use the digital marketing and the data to target the right customers. We're going to price the services much more effectively, right? We're going to then use data and other technology to train your employees more effectively, right? It's not like you're just going to be like, here's a written packet, read this and sign it. There's much more advanced training protocols now. So you get better training, faster onboarding, better pricing, better marketing, right? Better risk management too, because you can manage these companies kind of at the parent level, more efficient HR, right? Like everything becomes more efficient. Margins expand, quite a bit, not exponentially, but in some cases they do, right? But that's a traditional business that's completely recession resistant. it doesn't matter if the S&P 500, was worth 50% less tomorrow. You still have to get your toilet fixed in Texas or your air conditioning in Florida, right? It does not matter. And so if you're the company that's rolling those up and utilizing technology to immediately increase margins and efficiency or through efficiency, well, that's a business that's got not only scalability, because you need these services in every single house in the US, but it also means that it's got defensiveness in the sense that when shit hits the fan, well, the plumber is still going to need to come fix it, right? Clean it up. Right. And so, so that's kind of basically, I think that to me is like a very clean example of how you can utilize technology for the most blue collar of jobs, right? There's also a lot going on in construction right now in terms of technology. If we had more time, I could go on and on about some of the amazing technologies that are being put to use now that are going to completely change the game, right? And so that's what I think smart folks are looking for now. They're not looking for the 10x unicorn. They're just looking for businesses that can get to profitability, that are going to be able to survive a downturn, and that can still grow at a consistently high rate, but it need not be astronomical. As a lender, we don't need a company to be worth $10 billion. Like, we're happy if we make our 15% and a couple points on the warrants, right? And so if they're growing at 30% each year, which actually, that's a lot. That would be incredible for a large, mature company. But if a company starts out doing, 20 million in revenue, and then the next year they're at 26, and the next year they're at 40, and the next year they're at 60, you're loving it as the lender, right? The equity investors, now they're like, it's a little slow. Like, I wish maybe that's not going to be enough. We don't really want to fund you anymore because you're not going to be, 100x return for us. But from a lending perspective, we love it. The warrants are going to, kick in. They're going to be worth something. All of our investors are going to be super happy because they're walking home every year with a 15% cash return in some cases, maybe a little, less after fees, but call it 12% is kind of the magic net number for income. Mm. You give somebody 12% net return with warrants and great diversification benefits, they will be your customer for life. And that's why this is taking off with the wealth advisor segment, because wealth advisors know what their clients want, and what they want: 12% net income with upside and the ability to have a nice diversified portfolio, and also tell a nice story at the country club. Hey, you know what? My advisor got me into these 3 deals on the venture debt side that I would have never gotten into on the equity side, because they were all snatched up on the equity side like day one, right? By all the insiders, right? Never got a look at it. But now I'm riding on their coattails, right? I'm getting paid to wait. I'm earning 15%, while those guys are sitting there with zeros every year, with this massive J curve. Like, what would you rather do? Earn 15% and get paid to wait so that you can kick in, big upside with the warrants, or maybe not get anything for 7 to 10 years, right? And my last thought on that is, big picture, the opportunity here is an innovation, right? So think of innovation as the asset class. And then the next question you have to consider as an investor is, how do you want to access it, right? As a former trader, I had a lot of ideas about where I thought the market was going to go. But then, of course, you have to figure out, how do you structure the trade? How are you going to play your idea? How are you going to implement it? And my view is that venture debt is the optimal way to invest in innovation, because it's the lowest risk approach with a lot of upside. Historical losses, which we did not talk about yet, are less than 0.5% per year, including the GFC period, right? And so you've basically got a 20-year track record of close to 20% total return with losses of less than 0.5% a year. And the better lenders are even lower than that. The best lender in the space, which is the biggest BDC, has loss rates less than, I think, 15 basis points, 15 per year. Silicon Valley Bank was less than 25 basis points per year in annualized losses on average over the last decade. So think about that.
Maybe I should clarify what that means. That didn't mean that they were loss-making machine.
That's their credit loss, their charge off, their loan charge off. So if they had a book worth $100 million, they wrote off 500K in a couple of loans that didn't perform, but then they earned a high interest rate on the other, 99.5%, right? So to clarify, to your point, there's never been a year in the history of venture debt when it's lost money, ever. Even 2009, it did not lose money. So if you look at the asset class across a 20-year time frame, you look at the S&P, where it's had some great years recently, but it also was down immensely in the GFC in 2022. Credit in venture debt, you're not seeing that. You're seeing 15% like every year, and so it's hard to beat that.
So another phenomenon we're seeing that you mentioned in your piece too is how more companies are choosing actually not to IPO and stay private for longer. So a couple of implications that I'm thinking about from our conversations here would be, one, even more demand. You say there's the demand and supply imbalance. There might be even more demand, I suppose, for venture credit, as well as just more opportunities for you to pick and choose then from the companies that you can lend to. Would that be correct? And maybe you can also explain like why we're seeing this, like why would it be an environment where more companies are remaining in private hands?
Yeah, so the biggest thing is that the IPO market's shut, right? So that's something that no individual company can control. That's basically like a macro factor. And so you've got an IPO market whose volume is down, I think, 92% over the last 2 years, from 21 to 23, right? So there's no exit. There's no exit via IPO. So even if you wanted to IPO, you can't. It's just not available. Like, I would love to date Cindy Crawford when, at her peak, but it's just not going to happen, right? Like, the ship has sailed, right? It's like the same thing with this. People can say we want to exit and we've got a plan to exit. Doesn't matter what you want. Market's closed. Come back whenever it's open. It could be 6 months. It could be 2 years. We don't know. So that's the first thing. But even before the IPO market was shut, there was more companies looking to stay private for longer. And I think that's because there's just more available capital. Like in the old days, 20, 30 years ago, you kind of had to IPO. Like that was like how you got your big exit. But as a founder now, there's a lot of ways to exit. You can via acquisition is the most attractive option right now. And so if you're a private company and you're putting up good numbers, it's very easy to find a buyer. I mean, if you're a good company, there's money out there. It's just not out there for everybody. And so there's that option, which is really being utilized by a lot of companies. And the option that I always kind of push people towards is just get to the point where you're a sustainable company and won't need to raise external capital, but basically bootstrap yourself to success and focus less on outsized growth metrics that are going to consume a lot of cash to get to, and focus a lot more on getting to sustainability, get to profitability, right? Even if you're smaller, if you're profitable, this idea of runway is infinite in a sense, right? I mean, a lot of folks will talk about runway. It's like runway means that you're going to run out of cash at a certain point. So if you've got 24 months of runway and you can't generate enough organic revenue to extend that runway, you're going to go out of business. It's the number one reason why startups fail. Like if you Google why do startups fail, number one reason, they run out of cash, right? I mean, which is true for any company. Like, I mean, you don't need to be a CFA charter holder to know that, right? And so so there's a lot of companies now that are just saying, okay, you know what, we're not gonna build a company and a business model that's reliant on external funding, or certainly it's a lot less reliant, because they've seen what happens. Then your future is not in your hands. And so a lot of founders have pivoted, because they've been forced to, into building companies now that can reach this kind of steady state. But yeah, to go back to your question about why are more companies staying private, I think it's just there's a lot more private capital available. I mean, there's been an explosion in capital in the alternative investment space. I mean, that's what this whole paper is about that we wrote for the CFA, right? It's private credit strategies, private alternative credit strategies, not public bonds, right? Like there's a lot of money in the private markets now, and it's usually pretty smart money, and it's very accessible now if you've got a good business.
So to protect yourself is some of the risks that come with that, though. You have the covenants that people may have heard of, the covenants, and also the covenant light, meaning lesser covenant. How important is that you have the right covenant? Is that kind of a boilerplate thing that you write the same for all companies? And is it the covenant light? Is it becoming more a phenomenon that lenders are not demanding as many protections? So yeah. I'll let you take that, and maybe we should explain. I realize I should explain what covenants are. Basically, it says in the contract things such as you cannot have, less than this amount of debt, or take on a lot more debt, or things like that, and other ways having to do with how you capitalize and run the company.
So I want to take a half step back, I
Sure.
think this will kind of help. So what you're getting at is how do you reduce risk in venture debt? If you're the lender, how do you make sure that you're going to get paid back? And when you do have defaults, that your loss given that event of default is not that high, right? How do you maximize recovery rates, in other words, with bad loans? And it all, in really simple terms, I would explain it to folks as the 3S rule, right? Keep the loan small, right? And I'll go back and what that means. Senior and secured, and short, meaning like short duration, short maturity. So let's start at the top, small. Typically, lenders, when they make these loans, are looking at the enterprise value of the borrower. And the good lenders that have done this well for the last 2 decades want to keep that loan to enterprise value less than 20%. And looking at a lot of the data more closely, it tends to be like 12 to 15% is the right range. And in this market, a lot of lenders are actually looking for LTV, loan to value, less than 10%. So if you think about that, to put that in concrete terms, we take a company that's growing, that's doing well, and we value it at $100 million. And this is a realistic valuation, not a pie in the sky VC valuation in 2021. This is credit folks saying, okay, what is this company really worth based on their ability to generate cash flow? Okay, we think it's worth $100 million. Therefore, we're going to make them a loan of $10 million. So the company's worth 100, we're giving them 10 million in debt. So the company could go out and destroy 90% of their value, which they're probably not going to do if they're trending really well and have good traction. But let's just say something happens and they fall off the tracks completely. They could lose 90% of their value, and your loan is still 100% covered, right? So that's the first thing. Keep the loan small. This is a principle that applies to all credit, like all these principles do, right? It's not like venture debt is different from, in most respects, from other credit products. It's like we've seen all these pieces. They're just stitched together in venture debt in a way that no other product stitches them together. But each of the components is well known. And so it's kind of funny because people ask me like, well, what do you know about venture debt? You didn't start out in venture debt. You haven't done a bunch of venture debt loans for the last 20 years. You don't need to. Credit is credit. Analyzing companies is analyzing companies, right? And it's not like some like magical formula that enables you to make a venture debt loan. They're actually like very simple loans, much simpler than the loans I used to make when I was, at a major bank, underwriting like $500 million loans, right? So you start with moderate to very low leverage, right? In this market, I would say keep the leverage very low. In a hot market, you might not need to have like moderate leverage on the company because there's just more competition and more people trying to lend to them. So small, that's the first thing. Second thing, keep it senior and secured, meaning you're at the top of the capital structure. You've got a lien a perfected first lien on all the company's assets. So if they default, you're getting paid back first before anyone else in the cap table. All the equity folks are getting paid after you've been made whole, right? So small, secured, and then last but not least, short, meaning don't make you're not making a 10-year bullet term loan here. You're making a 3-year loan, let's say, on average. Typically structured as the first year will be interest only, and then the loan starts to amortize, okay? So this is really important. This is actually one of the things that really de-risks venture debt. And I actually wrote about this in, I read a column in Venture Capital Journal every month on venture debt. In the February edition, really focus on how to recover value in a venture loan if things go wrong. And this is the example I used. So say you've got a 3-year loan. So it's a $10 million loan. First year is interest only. So you make 15% as the lender. And then after that 1-year period, the loan starts to amortize. So it's going to amortize, meaning all your principal is going to get paid down in monthly installments over the last 24 months of that loan. So let's fast forward to the 2-year mark. So you made the loan on day one, now you're 2 years in. You've received 2 years of interest, which is 30 points, right? 15% per year. You've also, in year 2, been paid down 50% of your principal because the loan started amortizing, right? So the loan principal is going to get paid down fully in years 2 and 3. So you're halfway through that amortization period. So mathematically, you've made 30 points in interest and you've been given back 50% of your principal. So for every dollar you put in on day one, you've received 80 cents back already, and you're 2 years in. So if a company starts to go off the rails, well, you don't actually have that much risk exposure out there. It's not like you are the equity investor with 100 units of exposure. Like you only need to make 20% of your money back, or 20% of your original investment back to break even. And don't forget, you're protected because you're the senior secured lender, right? And so you need 20 points back to break even on a $10 million loan. So you need to make $2 million on a $10 million loan. And the company was valued at $100 million when you made the loan 2 years prior. So in other words, to break even on the loan, or to lose money, I should say, on the loan, the company would need to be worth less than, they would need to lose 98% of their value, right? So, and then I would ask you, or any observer, what's the probability that a company that is doing really well today, that's raised a bunch of equity capital, that's got a great team, a great product, great growth trajectory, good runway, right? Every box is checked, and you put it through thorough due diligence, make them a loan, and then 2 years later, they've lost 98% of their value. The probability is very low, right? Again, you don't need a CFA charter to figure that out.
Sure. Well, 98%, I'm thinking is as good as 100%, right? If the company is only has its toilet rolls and left in the bathrooms. But when you do have that situation, I understand that you have made money anyway, and all the other deals went well, so it's all good. However, the question begs itself, which is, well, how often do you then sit down on the table? They're going to come to you and say, look, it's just a temporary thing. We're defaulting. We got to go under, though, if we don't get a little more capital. So why don't you extend us another loan? Like, how often does that happen? Do you end up, when you get a default, you're not pulling out, you're actually trying to help them because you understand that, oh, well, it's in my interest to keep the company going. So how often does that kind of situation occur?
Yeah, so it's a great question. Lending to startups is very different than lending to a mature Fortune 500 company in so many respects. And one of them is that things are going to change a lot. And as a lender, you have to be prepared for that. And so the probability that a company hits their day one projections that they give you is very low. It's probably, I would guess it's like 5 to 10%, right? They're going to miss. That's okay, because any astute lender is anticipating that, and so they're building their assessment on realistic projections, and they're sensitizing and scenario testing downside scenarios, right? And so there's definitely the need as a venture lender to be a true partner. And if you panic the first time a company trips a covenant, you're not meant to be in the space. And this is something that every venture lender I've ever spoken to will tell you. And that's that you have to be willing to work with the company and realize that there's going to be a lot of volatility in their operations. There's no other way around it. That's just the nature of an emerging, fast growing business. So you have to just know that and build your process around that. Like, and this is again why it does not work at most banks to make venture loans, because banks typically, I've worked at some as an underwriter. I've underwritten billions of dollars of loans in media and telecom technology. And what you're looking at are things that startups don't have. What don't startups have? A 5-year track record of audited financials. Almost nobody has that, right? For most of these loans. Most mature companies have a lot of hard assets, right? They have like mature businesses. Startups, they're asset light typically. I mean, they have valuable intellectual property and other assets, but they don't have property, plant, and equipment that you can just seize if you need to, like you would with a mature company. So if you're a bank lender, you're looking for track record, you're looking for collateral, and most importantly, you're looking for cash flow, like profitability, like significant profitability. Startups have none of those typically, right? And so this is also why, as a lender, you're better served being outside the bank market, where you can be more flexible, because you're basically getting paid a complexity premium. Like if you ask me, well, why are the rates, why are you getting paid 15 to 20% if when the risk actually isn't that high? And it's because it's complex. It's harder to scale because these deals are a lot smaller. Like, you're not going out making $1 billion term loan. You're making like a $10 million loan, right? But the work that you put in is going to be equal to or more than you would for a big loan, right? Like, think of it like this. Here's an easy example. Say a Fortune 500 company wants a loan. You're going to do your underwriting. You're going to look at the management team. The reality is, as long as they're not doing something that's nefarious and they're not in the news, you're spending about 5 minutes on the management team. Like, I don't need to know who's the CEO of Microsoft, because they're a $2 trillion company. It literally doesn't matter, right? For a lender, But if you're analyzing a startup, you're going to spend a huge amount of time analyzing that leadership team. You want to know, everything about that founder. Are they truthful? Do they have integrity? Do they do what they say they're going to do? Are they resilient? Are they resourceful? Are they creative? Like, that is what you're analyzing in a lot of these companies as one of the main factors. Of course, you're analyzing all the financials and many other things as well, but you have to do qualitative due diligence on people. And that takes time, and it's easy to get wrong. So there's a lot of complexity there. And so you as a lender are going to get paid for that, because it's not an easily commoditized product. Like, Bank of America wanted to do this tomorrow, no chance. Zero, zip, not. Like, they wouldn't be able to do it. Like any of these big banks. Like, that you need to have a specialized skill set.
So you're being flexible. Does that mean, yes, you would sit down in a table and talk, and then you might end up extending more loans if somebody defaults and things like that?
Oh, well, I mean, look, every situation is different, so I'm not going to generalize, but I will tell you this. As a lender, you're getting paid monthly in the majority of these loans. It's not quarterly pay, it's monthly. You're also getting incredible information flow, because typically, if you structured the deal properly, you're going to be a board observer. Like, you're literally going to be at every board meeting. So you're going to see well in advance what's coming up ahead. This is not like the public markets where like you're blindsided by something, because you're in the board meetings, right? And so if stuff starts to go wrong and you're seeing, oh, okay, growth is slowing, or this strategic decision they made, is not playing out the way they thought it would, you have the ability to rectify it, right? And so in other words, your monitoring of these loans is exponentially higher than monitoring a public loan to like a large corporate, right? And when there's one of the best venture debt lawyers in the space who does on the transactional side, who has been doing this for almost 25 years now. When I asked him, I said, in your opinion, having done 7,500 deals that he's looked at closely over his 25-year career, and he said, I've looked at 3,000 from SVB, 1,000 from Bridge Bank, 1,000 from Comerica, and 2,500 from the non-bank lenders. Was his estimate, right? This guy's seen more deals than anybody on the planet. He said the number one reason why losses are so low is because you're monitoring them so closely, right? So if you structure these deals right with the 3 S's that I said, right? They're small, they're senior secured, and they're short. Senior secured is 2 S's, but think of it as just secured. Small, secured, short, and then you monitor them closely, you're not going to lose money 99% of the time, or 99.5% of the time is what the data shows, actually, right? So you're gonna write off 0.5% each year in losses, and then the rest of your portfolio, the 99.5% of your portfolio is going to be producing close to 20% return. So you can do the math, and that's how you get to high teens return every year.
So people listening to this wondering, probably sounds all great. I'm going to get into this space. If you're an investor or saver, I think most people may be familiar with the kind of fund that you have. You can come in as a limited partner. There'll be general partners, and you sign the contracts and things like that. Now, you mentioned previously the business development companies as well. Yeah. What is that? Maybe you can give an overview on this. What's the difference between that and the kind of fund that you are running?
Well, so I would actually flip your statement. Most people actually have no idea how private funds work. I know this having talked to...
I didn't say they know how they work.
They don't even know how to invest in them. They don't understand the concepts of a drawdown fund. Folks that are sophisticated institutional investors that are in the alt space get it. The RIA segment actually does not get it. I've talked to hundreds, if not probably 500-600 CIOs in the last couple of years at RIAs. The majority don't know how closed-end funds work, where basically they commit the LPs in the fund, the limited partners, commit capital on paper. They sign contracts that they're going to fund deals, and then as the fund, the general partner, the GP, does deals, they call down that capital from the investor. So if you are an investor in my fund, Lada, you'd say, okay, I'm in for $10 million because I love venture debt and I think you're a good fund manager. And say, great, the 10 million is going to sit with you. You can do whatever you want with it. You could put it in a fixed income ETF or under your mattress. I don't care. But now I go and do a deal, and that deal is going to represent 20% of the fund. I'm calling you, hey, you put in 10 million. I'm calling 20% of the capital to fund this deal. You got to kick in $2 million, and you've got 10 business days to do that typically, right? However, you're locked in for 5 years. There's no liquidity. This is not a mutual fund. You can't say like, oh, I'm getting divorced. I need more liquidity. I want out of the fund. It doesn't work like that. And a lot of people don't get that. They're like, hey, I'm used to just being able to like sell shares on a screen. Well, great. If you want to buy and sell shares on Robinhood, go right ahead. If you want to earn, big bucks in the private markets, you better understand liquidity and you better understand the GPLP structure of funds. And most don't. And so to your question though, so BDCs, there's both public and private BDCs. I'm not going to go into you can Google what a BDC is, but it's a structure that enables loan portfolios to be traded under a stock ticker, essentially, right? So you buy the stock, the underlying assets of that company though is a loan portfolio. Okay. So the biggest out there, so basically the biggest lender in the space right now is Hercules Growth Capital. Hercules has always been the biggest non-bank lender, certainly in the last like 15 or 20 years, and they've had a great track record. And so you can buy their stock, and the ticker is HTGC. However, before you rush off and buy it because you love venture debt, you got to think of the risk. And so what's risky about any publicly traded entity is that there's market correlation and there's beta risk, which CFA charter holders will understand. And so here's an example of what happened. This is a real life example. So if you go back to February of 2020, this is right before COVID hit. Hercules stock was trading at roughly $16 per share. Okay, on February 21st, I know this because I've studied how all these folks have done. On February 21st, they were trading at $15.99 per share. Okay, so it's called $16. Pandemic hits April 3rd, exactly 6 weeks later, in terms of calendar days. 42 days later, their stock's down to $6.64. So they've lost 60% of their value in 6 weeks. That's really, really, really hard to do. Okay. Now, during that same period, on those same dates, the S&P 500 was down 25%. So you basically got the best lender in the space, right? Very strong track record of, I think they've deployed roughly 16 billion or more of capital into venture loans since like 2004, roughly, right? And you can look this up. It's all public on their website or in SEC filings. So they've deployed 16 billion in hundreds of loans over the last 15 plus years. And their annualized loss rates are like 10 basis points a year, right? Like they basically don't lose money. Okay. However, so you might get really geeked up about it and think, wow, man, this is a home run. Like I love what Zach's saying. I'm going to go buy this stock. Yeah. Good luck with that. Because you buy the stock, something happens in the market. The BDCs trade with relatively high beta, meaning they move more. They're more volatile than the market. And you could be down 60% like Hercules stockholders were. So imagine you're an allocator or an individual investor and you're like, I really like this idea. I'm going to go buy Hercules stock or any of the BDC stock. And then we get hit with some bad news. Inflation's higher than we thought. Unemployment numbers pop up. We head into a recession. Well, all of a sudden, those stocks are going to be down because if the market's down 30%, they're going to be down 50 or 60%, right? Like we saw in 2020. Market was down 25%, Hercules was down 60. Now, they bounced back because as the market, got kind of used to, or as the market recovered from that initial shock, everything bounced back and people realized, wow, well, the underlying loans in that portfolio are rock solid. Like they're not going to lose any money now, right? And then it became actually a home run trade. Like if you had bought at the lows, you would have made, big return on it. So anyway, the point here is that structure matters. It's not just if you love the strategy, you have to figure out how do you want to play it. And I really think that the way to play it is in private funds because you don't have that market volatility. Because as a private fund, you don't really care what the stock market did yesterday. You're marking the underlying value of your portfolio. And if you can show that the portfolio is performing, you don't need to mark it down. Why would you? Right? And so there's less volatility over the short term. There's also what I think is a huge opportunity is co-investing opportunities. So if let's say you're an LP, you're an investor in a private fund, like our fund, for instance, we would give you the ability to co-invest in certain deals. So we'd say, okay, we're doing a healthcare deal. And perhaps you're an investor who has deep experience in healthcare and you really love that deal. Well, now you can invest more in that deal alongside us. So we'll do all the work. We'll source the deal. We'll underwrite it. Right? We'll manage the portfolio, but we'll also have a sidecar vehicle essentially that you can invest in. So you'll get exposure to that particular deal. And oftentimes you can do that at a reduced fee as well. And so there's that advantage. So I think there's different strokes for different folks in the sense that a lot of people really want liquidity and, liquidity is great, but you also pay for it. And I always said like, what's the point of liquidity if you're just selling at the lows? All you're doing is locking in losses. Like it's not really that exciting. If you look at how well people have performed over the long term, the people that just buy and hold outperform immensely versus those that tend to be short-term traders. I mean, that's proven in multiple academic research reports, right? So in a way, being in a private fund forces you to be smart and not panic because you want to panic and you're like, I want out. And when you want to get out is when you shouldn't be wanting to get out, right? You should be buying at that point if you have liquidity. And so being in a structure where you're locked in prevents you from being an idiot, basically, right? It prevents you from selling at the lows, which is what so many people do. Like all the people that sold in 2008, 2009, and then bought back in after the market had already like recouped all its losses. It's just silly, right? So, just being locked into a great product forces you away from those negative behavioral biases.
Yeah, I mean, it does sound like if we're gonna try to answer the question of like which strategy is best for which, if liquidity matters a lot to you and you have the stamina not to sell at the bottom, then that could be a way to go. Well, as we talk about
sorry, just last thought on this is, institutional investors are going to be very different from retail investors in what they want and their ability to create access. To be honest, the space is not big enough right now for a lot of the bigger allocators to get involved, because they want to write like if you look at like big pensions, for instance, like the big state pensions, they want to write minimum checks that are a couple $100 million. That's bigger than some of these venture debt funds in their entirety. So there's a disconnect there. So it's very hard for large institutional investors to get access because there's just not enough capacity. And the best managers are typically those that are more niche and nimble and specialized. It's not SVB. Like, their returns were shit. It's basically, and by the way, you buy their stock and you get all the other crap in the bank. You wouldn't get direct exposure to venture debt, right? So if you want direct venture debt exposure, you've got to go to the smaller managers that have a specific niche strategy within venture debt, but those are going to be too small for the large institutions. Now, on the flip side, they're also going to be too complex or maybe don't have enough track record or enough brand recognition for the retail folks, right? So this is part of the reason why the asset class has actually not grown as much as it should have grown, because a lot of the money that could be going into the space doesn't really like fit. They don't really understand it. They hear the word venture and they get scared and they go, we don't do venture, which is like, by the way, if you ever hear somebody say that around venture debt, they don't know what they're talking about, because it's not venture. It's senior secured loans. That's why my fund is called the A.R.I. Senior Secured Growth Credit Fund. We're not doing venture. We're making senior secured loans, providing growth credit to the best venture-backed companies.
You mentioned a common interest rate for the company to pay being 12 or mid-teens, maybe a little above that. So if as an LP, how much is an LP invested in a fund like your own expected to get, knowing that some of the returns gets eaten up in management fees and the carry or performance?
Well, think about a 2 and 20 fee structure. You can do the math based on that, right? So typically, you're going to get like call it 14, 15% net if it's a fund that's producing about 20%, right? Also, another thing that's nice about the private fund structure is there's often what's called a preferred return hurdle, meaning the manager has to produce a certain level of return for the investors. And if they don't hit that return, the manager actually doesn't get that 20% profit share, that 20% carried interest, right? And so that level varies, but I've seen in the market anywhere from 6% on the low end when rates were a little bit lower to like 12% with a fund that was trying to get more traction, right? And so what that means is if you're the investor and their fund returned 9.9% on with a 10% preferred return hurdle, the manager is not making that 20%, so you're walking away with the 9.9%. So I would say where I think the rubber really meets the road in terms of really delivering value consistently is in getting investors like a 12% cash return, and then also having those warrants as upside. And so all in, like a mid-teens total return is very achievable without taking undue risk.
Wow, that's great. Well, I think it's our viewers have gotten a clear picture of there are great opportunities in this space. It sounds like you think that the environment of supply and demand disconnect there is going to remain for some time, which it creates, of course, a great opportunity that is to be on the supply side of capital. So that's great. So maybe in closing, you can just tell us about what you do. Tell us about your company, Applied Real Intelligence, and what you do there.
Yeah, so I'm the founder of Applied Real Intelligence, which is the management company of the A.R.I. Senior Secured Growth Credit Fund, and so we are on Fund One. We're actually at a great place right now where we're soon going to announce our first slate of funded deals, and so it's taken a really long time to get here because of a lack of understanding in the market, and just building something from scratch is never easy, especially building it to institutional quality standards. All right, so we've got really, though, perfect timing. I mean, the way I think about it is the market right now is perfect in terms of the supply and demand imbalance. And fortunately, our timing is such that we weren't in the market making loans until now. Like, our first loans are going to be announced very shortly. And what that means is we missed that period in the market when people were making a bunch of bad loans in 2020, 21, and 22. Like, that's going to be probably the worst vintage in the last 20 years in a lot of credit products, right? But especially but venture debt, I think will still do well. I mean, don't get me wrong, I think it'll still do fine, and a lot of these lenders are very talented. But look, the market dynamics were such that if you were in the market in 2021 as a leading incumbent provider of venture debt, you were putting money to work at the wrong prices with the wrong deal structures, with companies that were worth a fraction of what you thought they were. And what that means is that there's a big mess to clean up now. And so if you look at the public filings of the BDCs on the SEC's website, for instance, you can see they're really not putting much capital to work. And I think it's pretty clear that most of the capital that incumbent venture lenders are going to put to work is going to be in their existing portfolio companies, because there's literally nobody else to fund them, right? So to your point earlier, Lana, when you're saying like, what happens when stuff gets bad? Like do you work with them? Yeah, they're going to be putting more money into these companies. And, quite frankly, these companies will probably do well in most cases, right? But the lenders are going to have to bridge them to some type of exit because they lent to them, again, wrong rate, wrong structure, wrong valuations, right? And as much as I love venture debt, you couldn't pay me enough to have a portfolio from 2021, right? And so the opportunity now is pretty clear. Find venture lenders that have some kind of niche competitive advantage in this segment of the market, whether that's geography, sector, stage, founder type. Find those lenders that have that focused expertise and that don't have a legacy portfolio that's going to blow up their firm and basically ruin their performance. And if you can find that, you're golden. And there's not really that many companies doing it, which is why I'm very, very fortunate and thankful that we're coming to market when we are. I mean, part of that was because the market kind of dictated that. Part of it was by design. I mean, we've had money raised for almost a year now, and I've looked at hundreds of deals and haven't pulled the trigger because there was a lot of dislocation and a lot of adverse selection. Like, basically the people that come to you that need money are those that you would probably not want to lend to, right? It's like, it's always like this in the credit markets. We always think of this saying that, like, if you need money, you probably don't deserve money, right? Like, think about who can raise money cheaply in the debt market. It's credit-worthy companies. If Apple or Google wants to raise money, they can raise it all day long, very cheap, right? But if a company who's like, hey, if I don't get a loan or some kind of capital in 3 to 6 months, I'm going to go out of business, why would you want to lend to them? So perfect market.
It sounds like we're having this conversation in the perfect time. And we're coming out with our piece with the Research Foundation in the perfect time as well. So go ahead and everybody check that out. And thank you so much, Zack Ellison, for taking the time to give us a tremendous overview of venture debt. Fascinating. Thank you.
Thanks for having me. I appreciate it.
And thank you, everyone, for tuning in to the Financial Thought Exchange podcast. I've been your host, Lotta Moberg. had Zack Ellison with us today, and we will see you again next time.
For more information, please visit rpc.cfainstitute.org/research-foundation.